Welcome to Microcap Explosions and Classic Value Investors. This is Mariusz Konieczny. Today, I have a special guest with me. You see, some of you guys have been following me for some time, and we all made a lot of money in some of these picks, including myself. And so I wanted to bring someone on and to kind of introduce you to other ways of what you can do with your gains, other ways that you can invest and maybe diversify. So I am here with Marco Santerelli. Marco, thank you very much for joining me.
Hey, it's my pleasure, Mariusz. I appreciate you inviting me on, and I'm excited to talk about what we're going to talk about today.
Yeah, so we're going to talk about real estate today. I used to be a real estate appraiser. I used to be a real estate broker right after I graduated from college. It's been a while. So I kind of am looking at my own gains, my own portfolio, and I'm starting to kind of think about real estate again. So I thought I would bring you on and talk about it because I think what you do is very interesting. So can you take a few minutes and maybe like introduce yourself to my audience? How did you get involved in real estate? And we'll just kind of go from there.
Sure. So a short answer to that question is I'm the founder and CEO of Norada Real Estate Investments. We are a nationwide provider of turnkey cash flowing investment property. These are residential properties from single families up to fourplexes. And we're in about 25 different markets. Now, I started this company about 18 years ago because I was investing heavily in real estate at myself. In fact, I started when I was 18 years old, which was a long time ago. But in the process of building my portfolio in the early 2000s, investors were coming to me saying, "Hey, Marco, can you help me? Can you coach me? Can you mentor me?" Because I had purchased 84 properties, 84 doors in 9 months. And so I was just acquiring a lot of property very quickly. And people were watching and seeing what I was doing. And they were saying, "Hey, I don't know what you're doing or how you're doing it or what your system is, but I'd love your help." And I said, "No, I don't have the time. I'm sorry, but I do have deal flow." So that's how the business started, is just people coming to me. But my past is pretty simple. I was always interested in business, entrepreneurship, investing, and real estate. And I studied it literally when I was a teenager, about 14, 15, 16 years old. I was reading books, but I couldn't do anything because I wasn't legal of age. And so I had to wait until I was 18 years old before I could buy my first rental property. But that's what I did. And most people look at that and say, "Holy crap, you bought a rental property at the age of 18. That's amazing." Like most 18-year-olds are just starting college. I did go to university for 5 years, 4.5 years, while I was doing this. But the thing is anybody can do it. It's not difficult, and it's arguably the best and most historically proven asset class in history, at least arguably in the last 150 years. So I knew real estate was the way to go to create wealth and to create long-term passive income. And that's exactly what I achieved. Now, today, we help people do the exact same thing. We educate for free, we provide services for free, and we just want people to build their financial freedom however they like, but hopefully a lot of it comes out of investment real estate.
How did you, when you first got involved, what kind of books did you read that inspired you to become a real estate investor? And how did you find the deal flow?
Well, depends on how far back you want to go with this question. When I was a teen, I was reading product. Thing is I couldn't drive. Just getting my hands on whatever books I could, but most of the stuff I read came from Hume Publishing. I don't know if they're even still around today. It's HUME, but they would publish binders, and they would sell you a chapter a week, and you just get it in the mail. So you didn't get the whole thing at one time. You subscribed, and it was just a weekly module. But I built up a library of these courses, and that's where I cut my teeth. Learned and cut my teeth. But fast forward to the early 2000s, that was the time of Robert Kiyosaki. I believe, that was around the time when Robert Kiyosaki was really starting to become a well-known author.
You see, that's actually the book that got me into real estate was Poor Dad, Rich Dad. So please continue.
Yeah, great book. So I know Robert Kiyosaki. I've interviewed him on my podcast. I have all of his books, and if you actually fill the library of the Rich Dad series of books, it's about 30 books. There's a lot of them. But it's great content. So that was the type of information I was consuming, not just on real estate, but also on tax strategy and asset protection. The thing is here's the bottom line. I'm not suggesting that your audience listen to this and say, hey, I don't have the time to read books. I like reading, or maybe I don't like reading, but I know I need to educate myself. The bottom line is this: you have to become a lifelong student. And that's what I did. I'm always hungry and thirsty for new knowledge and new information, especially when it comes to investing. So I consume something every day, whether it's an audiobook or I'm reading, and I just want to keep learning, because the more I learn, the more I earn. It really is a fact. And so you should always be working on yourself. And so what does that mean? It means you're investing in yourself, investing on this thing between your ears. So if you make the investment here first, it will manifest itself in your material world around you, because you'll be more aware of opportunities. You'll be able to identify them, evaluate them, take action on them, build a team around you to help take action on those. So be a lifelong student, invest in yourself, which means invest in your brain and your knowledge. And it'll be amazing how that starts to compound and manifest itself 6 months, 12 months down the road.
Okay. And in terms of finding deals, like how did you find deals back then, and how do you find deals right now?
Well, those are two separate things, but they have similarities. So back then, I didn't have a team. I was a solo investor, a solopreneur, and a solo investor. And so I had to go out and hustle, and I had to figure out what markets to invest in on my own, doing my own research. I had to find the right people to work with, the real estate agents, the mortgage lenders and mortgage brokers or banks. I had to find the property managers. And believe me, I had failures in all these areas, because I got ripped off by many different people, from agents to contractors to property management companies, even overspent or just got bad deals from mortgage hungry or unethical mortgage lenders, mortgage brokers. So you have to do a lot of legwork and research and vetting of people to build your team. But that's what I had to do in order to find the deals. And a lot of it was coming off the MLS, the multiple listing service, in the markets that I was looking at, through the agents I was working with. So it was a lot of work. It was a lot of work. Today, as a company, we have relationships across the country with new construction home builders, as well as high volume property providers. So our inventory comes to us completely turnkey, rent ready or completely leased, no deferred maintenance. I mean, they're completely turnkey. So we take that inventory, and that's what we provide our investors, depending on what their investment goals and criteria are. So that's our source today. So me personally today, I'm just buying from the same pool of inventory that all our investor clients are buying from. I can just see it all, and I can pick and choose what I want depending on what market I want to be in. My last acquisition was in Florida. So I just had the right deal. It checked all the boxes for me. And that's the one I put under contract and purchased. So today it's a lot easier than it was before. However, if you're listening to this and you want to do it all on your own and reinvent the wheel, you can do it. It's just, why reinvent the wheel when all the pieces are already there available to you? So, but that's how I did it there, and that's how I did it now.
And then, so what kind of properties do you specialize in? Like, if let's say you take someone who's just starting out, or maybe versus someone who has $200,000 of assets. Like, would you tell them different things of what they should do if they wanted to take some into real estate?
Well, first of all, where you invest and what you invest in is going to come down to two basic things. One, what are your investment goals and your investment criteria? Meaning, what is it you're trying to achieve, and what are you looking for? And you may not know the answer to that question. When you're talking to, let's say, me or one of my 6 investment counselors, we're going to help you define that. If you don't know it, we'll pull it out of your head. We'll get you clear on what you're looking for and looking to do. But that's the first step. The second thing is the amount of investment capital you're working with. Someone who's working with 20 to 50,000 or 100,000 has a certain number of options in terms of markets and the size or numbers of properties. Someone who's working with, let's say, 500,000, 200,000, $1 million of investable capital is going to have a slightly different approach. Their strategy will be a little different because they're looking for maybe a little more scale. So what we focus on primarily are single family homes, duplexes, triplexes, and fourplexes. That's what the lending world classifies as residential. Even though anything above a 4-unit, like a 5-unit, a 10-unit, a 20-unit apartment or bigger is still residential, in the lending world, it's classified as commercial, not residential. So your financing options and financing terms are best if you're investing in 1 to 4 unit properties. And that's why we spend 95% of our energy on those types of properties. We do have larger properties. In fact, we have a client right now looking at a 20-unit, small 20-unit apartment building. It's funny to call 20-unit a building, but it is an apartment building. But we don't have a lot of those because they're much harder to find. As you grow and scale, there's fewer and fewer and fewer of them. And in actuality, in today's environment, the deal isn't as good most of the time in terms of your cap rate or your cash on cash return. So they're not necessarily the best deals. As a general rule of thumb, most people, regardless of whether you have 50,000 to invest or 500,000 to invest, you're far better off, in my opinion, both I can qualitatively, quantitatively, to invest in single families, duplexes, and fourplexes than you are in something that's in a larger scale. Your cap rates are better. Your appreciation potential typically is better. Your cash flows are going to be stronger. It's easier to maintain. You get a better, anecdotally speaking, a better quality tenant because the smaller the unit, the better the quality of the tenant. I'd rather live, and I'm sure you probably feel the same way, in my own home, like a single family detached home with no shared walls, my own yard, and complete privacy, rather than being in a small apartment building where I'm sharing like at least 2 or 3 of my walls with other neighbors. So you tend to get a better and less transient tenant when we deal with smaller and smaller units. So
And
that's
you touched upon the financing. So give me an idea of how the financing in terms of down payment and maybe interest rates it would look on a residential versus like a commercial classification.
Good question. So with residential financing, lending on what we call non-owner occupied homes, meaning that you don't live in it, the financing is called conventional financing. They're conventional loans. You're allowed up to 10 per person, 10 per credit score. Beyond that, we have other options. Those are called portfolio loans. But the cheapest form of mortgage financing available to anybody in the U.S., doesn't matter if you're a resident, a citizen or not, it doesn't matter, are the conventional loans. So you can get a 30-year fixed rate interest mortgage loan, which is unheard of in the world. There's only 2 countries that have it, and the U.S. is one of them. The interest rates are at historic lows. For owner occupied, you can get, in the upper 2 to 3% range. If you're non-owner occupied, you're typically in the upper 3, but usually in the 4% range. And the key point here is this: that low interest rate is locked in for 30 years.
No balloon payments. No balloon, right?
It's right.
Yeah.
It's fully amortized. So in the course of that 30 years, your tenant is paying off that mortgage. And each month that they pay it off, your principal is reduced, which means your equity is increased a little bit at a time in the beginning. But as time goes on, it's like faster and faster, more and more. So tenant's paying off your mortgage, which is fully amortized and paid off in 30 years with a fixed interest rate that doesn't change, which means your monthly payments don't change. And that's a beautiful thing, because if you stop to think about it in the context of inflation, and we've had inflation for a long time, and especially in the last 12 to 18 months, we've had some really good inflation. So the purchasing power of our dollar is going down, but that's a benefit to you as a real estate investor. Think about this: if you have a 30-year fixed rate mortgage, your payments are locked, your interest rate's locked for 30 years, and you are living in an inflationary environment, which we do, and we will. That means that the value of that mortgage each and every year is becoming worth less, meaning inflation is helping you pay it down or pay it off. because every year you're still paying that same $500 or whatever it is towards the mortgage payment. In 10 years from now, that $500 is going to be laughable. I mean, that's going to be the cost of a Starbucks coffee, but it doesn't change. So inflation is actually helping you because it's eroding away at your mortgage. You're still paying it in tomorrow's dollars, even though it's locked in at today's dollars. So if that doesn't make sense to people, just understand that inflation is your friend as a real estate investor for multiple reasons. There's multiple reasons, but that is one that most people don't think about.
You see, I remember on the commercial properties, you had to refinance your property every 5 years. So
yeah,
you didn't have the opportunity to get a fixed rate for 30 years. I mean, the amortization table was 30 years, but you had to refinance it every 5 years.
Yeah, and actually, in a commercial loan, the amortization is typically 25 years, not 30, and you're having to recast or refinance that term, that 3 to 5 year term every 3 to 5 years. So you can the length of the term within that amortization period. So that means every 1 to 3 or 4 or 5 years, whatever you've chosen is what you're locked in for, and then it's whatever the prevailing interest rate is at that time.
Yeah, and let me understand one thing, because I've read something that on your website that you said that the kind of properties that you're talking about are easier to manage, and that kind of made me think a little bit, because I was always under the impression that, let's say you have a 100-unit apartment building, that's easier to manage because you can hire staff and the units are next to each other. You have some economies of scale. And when you said that these properties are easy to manage, like they're located in different areas, like, can you elaborate on this?
Yeah. So first of all, those are two different comparisons. If someone has a 100-unit apartment building, they're going to have an on-site manager. The economies of scale, the economics of an apartment building, especially if you're 40 to 60 units or above, you can afford to have an on-site property manager. But with residential property, like if you have a portfolio of single families and duplexes, and you've got 3 to 5 in one market, 3 to 5 in another market, 3 to 5 in another market, you have two choices. You can self-manage, which a lot of investors do, and a lot of investors do it successfully. It's not that difficult. In fact, I'm actually interviewing someone here in 2 hours on my podcast to talk exactly about self-managing, the 5 benefits of self-managing your property. Do we necessarily suggest or recommend that people self-manage? Usually not. Most people are better off having a professional, full-service property management company oversee and manage their properties, their assets. That's the best choice for them. One, it makes it more passive. Two, it just takes your involvement out. You're just at the high level managing the manager, if you will. You're not even managing. You're just kind of overseeing your portfolio through your property managers. So you're truly an investor at that point. You're not in the operations. You're backed off, and you're involved in the investment side of it 100%. So having professional full service property management is the best choice for most people. It is the most passive way to go. It is worth the cost. Residential property management companies will charge anywhere from, let's say, 7% to 10% of collected rents. So that's just an expense, a line item on your, profit and loss, and you budget for that. But you don't have to go that direction. I just think it's best for most people, especially if you don't have the time to oversee your portfolio, which doesn't mean you're involved in it every day. I mean, there's tools and automations to make sure things just run completely smooth. But if you want to manage through property management companies, you're hands off, and it's like the check is in the mail. You just get a deposit every month from your property manager into your bank account, and that's where your principal, interest, taxes, insurance come out of. So deposit comes in every month, your PITI payment comes out every month. What's left over is your positive cash flow, and that's it. You just keep moving on with your life, your job, your career, your family, doing what you want to do.
Okay, so let's take an example of, let's just say someone has $100,000, okay, and they want to put it into these types of properties. And I know it differs from market to market, but still, like, what could someone expect in today's market to make on that $100,000 after paying the manager, after paying the mortgage, like cash on cash return for something like that?
Okay, so I'll give you as simple answer as I can on this. So when I look at $100,000 of investable capital, what that translates to me is anywhere from 1 to 4 doors, 1 to 4 properties. So that could be 1 single family home. It could be 4 single family homes. The reason there's a range, and I'm talking in general numbers here. The reason there's a range is because it comes down to the market and the neighborhood. Every market has different, property values, price ranges, and every neighborhood within each of those markets are going to range all over the place. A quick example is this: a single-family one-bedroom home in San Francisco can be $1 million. A 3-bedroom single-family home in, let's say, Northwest Indiana, in your backyard, or in some of the suburbs of Indianapolis, could be $100,000 to $130,000, right? So huge discrepancy. But in general terms, $100,000 of investable capital will turn into anywhere from 1 to 4 homes, properties, or 1 to 4 doors, depending on how you're looking at it, because you could be looking at duplexes or quads. Having said that, when you run your numbers and you also budget for vacancy and you budget for maintenance and repairs, which every real estate investor should do, a lot of agents out there and a lot of people who are selling property often will omit those two things to make the bottom line look bigger, meaning that the cash on cash return is higher and the cash flow is higher because they're not deducting for vacancy and they're not deducting for maintenance and repairs. That's a mistake. Even if you're not paying maintenance and repairs or having a vacancy for the next 2 years, which means it's all cash flow into your pocket, you should still budget for it. So when you do a true P&L or cash flow analysis and you deduct those things, what you'd be looking at, in most cases, there are exceptions, but what you'd be looking at is anywhere from $150 to $450 per month, net positive cash flow. From a cash on cash return perspective, that translates to anywhere from, let's say, 6 to 14%. That's worst case, best case scenario. It could be outside of that as well. There are, again, exceptions depending what your investment strategy is and where you're investing. But from a cash flow perspective, you're looking at a real rate of return on that immediate of 6 to 14%. Now I'm talking cash on cash return, but I'm going to take this one step further, if I may, because looking at just your cash on cash return is myopic. It's very short sighted, because if you're comparing real estate to other investments, whether it's like trading stocks and you're getting whatever gains you get, or promissory notes or any kind of investment where you've got a fixed rate of return or maybe a predictable rate of return, that could be whatever. It could be 2%, 4%, 8%, maybe more. Maybe it's double digit. But when you actually look at residential real estate as an investment, you're making a return in multiple ways. One is that cash on cash return, which is the real immediate spendable cash flow you get every month and every year from your property. But in addition to that, there's a couple others that you got to factor in. What we just talked about, excuse me, is your realized gains. It's real spendable cash today. It's a realized gain. It's income. But there's 2 unrealized gains, well, arguably 3, but 2 realized gains that you also have as a return on your invested capital. One is the amortization of that loan, which we just talked about before. Because remember, each and every month, each and every year, that mortgage that you have is being paid a little bit more every single month. Well, that's equity in the property, and that's still a return to you from the invested capital. So that's still a rate of return. In fact, if you take the average over 30 years, the rate of return is 6.66%. So if you take that whole 30 years and fully amortize it without prepaying that mortgage, your rate of return just from amortization is 6.66% per year average. On top of that is, over time, the appreciation on your property, which again adds to the value, adds to the equity. That's still a return on your original invested capital. And that could be all over the place. I mean, this last 12 months has been insane. I mean, the appreciation rates around the country, especially in the South and Southeast, have been off the charts. So that's also an unrealized gain. So when you add those 3 alone, your real rates of return are double digit. So they're easily in the teens. They're usually in the 20s and 30% range. It just depends, again, on the market and neighborhood. But wait, there's more. There's a fourth element here that people also need to consider, and a fifth one, actually. The fourth one is the fact that you have leverage. You can't do this with any other investment class. You can put down as little as 20% down to purchase and acquire an investment property and have 100% of the benefits, 100% of the tax deductions, 100% of the cash flow, 100% of the appreciation, 100% of all the benefits of that property, but only put 20% down. You're borrowing the other 80% because we have lenders all over the place tripping over themselves to lend on investment real estate. So you have this 5-to-1 leverage with real estate that everybody considers safe. That's why everybody wants to lend on real estate and give you as much as 80% down. And if that wasn't good enough, there's a fifth element. It's called depreciation. The IRS allows you to write off the improvements that you have purchased in that property, which is basically everything except for the dirt, and depreciate it over 27.5 years. And you don't have to spend a single penny or dime to get that depreciation. The beautiful thing about that is you're making income every month. It's real spendable cash in your pocket. But that depreciation allows you to show a loss on paper. Even though you don't have a loss, it allows you to show a loss because you could write off 1/27.5 of that property every year, which means that now you've lowered your income from that property to near zero, or maybe it's even negative. But that's on paper. You're still getting positive income, but you're not having to pay tax on it because that depreciation allows you to lower or eliminate that income on paper and pay nearly zero tax on the income. So it's tax-free cash flow. So there is no other asset class that you can do that with.
Oh, thank you for that explanation. Okay, so let's say somebody wants to get involved and someone has some cash and they come to a firm like yours because I do like the fact it's this turnkey. Like, walk me through this process. I come to you, I'm like, I have $100,000. What do you do with me?
Well, the conversation starts with a strategy session. This is a free call. It could be whatever, anywhere from 15 minutes to an hour or more. It just depends on the complexity of what you're dealing with. But you would be having a conversation with our team here, one of our investment counselors, and you would just get to know us. We'd get to know you. It would be a conversation of, here's what we can offer you. Here are the resources and the information and the knowledge and the contacts that we can provide you. And on the flip side of that is we want to get to know what you're trying to achieve. We want to make sure we can actually help you. And so it's a question of, where are you today? Where do you want to go? What is it you're trying to achieve? And what are you looking for? And we'll help you to define all that. It's very, very simple and a painless process, but it's good to be clear. So that's the starting point, is that first call we call a strategy session. And that might lead to another call and another call. It just depends on, how complex your situation is or simple. But from that, ultimately our goal is to identify your needs and your investment goal, then identify the market or the markets that make the most sense for you as an investor. We're operating in about 25 markets right now, mostly on the eastern half of the US, because that's where the numbers make the most sense. And I don't mean the coastal markets. I'm just talking about, south, southeast, the Midwest, pockets of the Northeast. So we'll identify markets. We'll identify the neighborhoods within those markets where there is inventory, which is a challenge today. We want to make sure there's inventory there. And number two, we've got the properties that fit your investment criteria. And then, it's a matter of asking questions, analyzing some properties, you and our investment counselors together, because now they have an understanding of what you're looking for. So we'll be able to present to you, properties that meet that criteria. Ultimately, when you've identified the one or two or three properties that you want to take action on, you'll put them under contract, and then you'll go into your due diligence period. You've already been doing some due diligence prior to this with us, but then you have two things going on. One is your inspection period, and two is you're working with one of the lenders that we'll refer you to. We've got about 5 or 6 that specialize with working with investors. And you'll work on your financing while you're doing your due diligence, which is primarily a full top to bottom inspection of the property, just to make sure there are no issues or red flags or anything like that. And then ultimately, within 40, 45 days of going to contract, you'll close escrow. You'll take possession of that property. You'll be the sole owner. You'll have all the benefits of that property. Um, we can also help you on the back end with, tax advisors and asset protection attorneys. We work with, a list of both of those people, and we'll connect you with those as well. So we help you from beginning to end. I like to say we figuratively hold your hand and walk you through that process. And everything I just described is at no cost to you. We don't charge a dime for the services we provide. So again, the question
how do you make money yourself?
I knew you were going to ask me that question. I get that question often. It's very simple. I built a very simple model. Our company is a real estate brokerage. And so you, as the investor, are the buy side of the equation. Our compensation comes from the sell side, the seller of the transaction, just like in traditional real estate. It's the seller that usually pays what you call a real estate commission, right? So our compensation is after you close escrow on a property that we've talked about, you've analyzed and done your due diligence on. Our compensation just comes from the sales side of the equation, the seller. That's why it's free to you.
It's interesting that you have this business model, because it's like you show the buyers how they make money. You educate the buyers on how they get involved. You walk them through it, and then so your benefit is you bring a buyer pool to the sellers, who compensate you for this. Very interesting.
That's exactly correct. However, I will add that it's only the sellers that we want to work with because we vetted them. They meet our criteria. They've checked the boxes for what we're looking for. They can provide the inventory we want and need, and they have a good reputation and a good history. If they don't fit that criteria, we don't work with them, or we fire them if we're working with them and they've changed how they do business.
And then the sellers that you work with, are they like repeat sellers? Like
Oh
builder?
yeah. No, these are long-term relationships. These are like new home builders and large scale property providers that are buying what I'll call distressed assets, and fixing them up. And just like you see on TV, you take a property that is doesn't look so nice, or is maybe needs some work and is not in very good condition, and then you just fix it up. You renovate that property so it's in like new condition.
Mm-hmm.
So, but they do it on scale. Like they're not doing like one every 3 months. They're doing like 30 a month. So those are the people we work with.
Okay, well, perfect. Okay, is there anything else that you would like to touch upon that maybe I didn't address?
I think you hit a lot of good points, and I think we talked about a lot of the benefits of investment real estate. I think a final comment would be something we just said before we started recording here, and that is there's a lot of people out there who are in different assets or trading, whether it be stocks, ETFs, forex, crypto, whatever it may be, that have these realized gains, or are sitting on a bunch of profit or cash, and they're wondering, well, what do I do with it? I know there's a lot of people, I mean, it's happening right now, that are looking to convert that into hard assets like real estate. Real estate is a hard asset, not a soft asset. It's not a paper asset. And so it'll be here today, it'll be here in 10 years from now, it'll probably be here 100 years from now. So when you can have a hard asset that's a good inflation hedge, that you can get 5-to-1 leverage, generate cash flow, and build equity, which is wealth over time, year after year, I think you're kind of crazy not to consider adding real estate to your portfolio or expanding the existing portfolio that you have in real estate. So, we just make it easy to do. We've done all the heavy lifting and the hard work for you. You can do this on your own. You don't need us. But just like I said before, invest in your knowledge, build your brain, invest in yourself, and take action and build a portfolio in real estate, because you'll be very happy and thankful that you did. 5 years from now, 10 years from now, you look back and say, that was a good decision.
Yeah, perfect. Okay, how can people get a hold of you, reach you if they have any questions or if they want to engage you?
I appreciate you asking. The best way is really just to go to our main website, which is Norada Real Estate, Norada, Norada, however you want to spell it, but noradarealestate.com. And then the sister website is really the name of my podcast, which is passiverealestateinvesting.com. And that's the name of the show, Passive Real Estate Investing. Either one of those websites link to each other, and we can help you either way.
Okay. Well, thank you very much for your time.
Marius, thank you so much. Appreciate it.